Ahead and get started. Good morning, everyone, and thanks for joining our quarterly investment update. I'm Kristi Grys, Chief Investment Officer here at Merriman, and I'll be chatting about what's been going on in markets over this past quarter and past month. Today, if you have any questions during the presentation, go ahead. You're welcome to put those into the Q&A. I am joined by my wonderful co-host, Sierra Butler, who is one of our wealth advisors here at Merriman. She joined us a few years ago after several years at Dimensional Fund Advisors. For those of you who've been with us for a while, Dimensional is one of the investment partners we work with and who's very aligned with our investment philosophy. Sierra is super passionate about working with individual families, which is how she came to Merriman from the investment side of the world, and particularly about helping families reflect their values through sustainable investing knowledge. She's a chartered SRI counselor. And she just recently welcomed Nora into her family, and she and her husband have been busy welcoming Nora and entering the world of parenthood, which I know I'm super passionate about that, and it's a wonderful phase of life. So she is joining me today, and she'll be monitoring the question and answer and chat boxes. And she knows to interrupt me when I'm going too fast or any of you have questions that might come up as we go through the material. So feel free to ask those questions anytime, and Sierra will know whether I'm going to talk about that later or whether that's a good time to step forward and interrupt me about what's going on. And with that, we're going to get started today. So markets, where are we? Where we've been. So if you've been on and joined us for quarterly updates over the past few quarters, you will remember that there's kind of been two major forces that have been driving the behavior of markets in kind of the recent years. The first being inflation. Where is inflation going? What is happening with the Federal Reserve? Are they going to cut interest rates? Is inflation going to tone down? Or maybe they're not. And we've been talking about whether there's going to be a soft landing, what's happening. So that has been a big driver in markets over the past couple of years, and also continues to be. So in some sense, we might sound like a broken record, except that that's really continues to be a major narrative in how markets are reacting and what direction they've been going. The second is AI. And that's the second thing we get the most questions about, and also has been the biggest driver in some of the positive behaviors in markets. And in both cases, markets are trying to foresee what's going to happen with these things. And there's a prevailing narrative, and markets are projecting a certain future. And then when that future doesn't come, that's when we tend to get strong movements up or down in markets. So those have kind of been the dominant narratives that have been driving markets over the past quarter and really over the past couple years. So with that, let's see how that has played out. So this is starting at the beginning of the year here. You'll see some lines and what's been happening with certain major market indices. The first is the S&P 500. That's this kind of darker bluish teal line here. And you can see that over the first quarter, when you might have read a quarterly update we put out, this is basically right at the end of the first quarter. It had been a really great time particularly in the US market. And this was, again, driven by two things. One, a lot of this was driven about investor sentiment that artificial intelligence and AI and the companies that were really benefiting from that were going to continue to see a boost. Earnings reports were very good. We'll talk about that in a little bit. And that really propelled the S&P 500, which has been a dominant asset class, US large growth stocks, to new highs at the very end of the quarter. At that same time, what happened right there is that we got a bunch of inflation data. The Federal Reserve started commenting more about interest rates. And instead of kind of this really positive narrative, and I hate to call it that because I think just because inflation is a certain level or rises or falls does not necessarily mean a positive outcome for the US economy or not. Certainly the stock market is reacting to inflation news with a negative sentiment. And we can see that there was a marked downward movement in the past month in every asset class. And we kind of see what's happening here. This yellowish line is international stocks. You can see that they've been lagging US stocks, but again, showing that same behavior, kind of a very nice upward trend over the first quarter, and then with sticky inflation news falling again over the past month. The bond index is kind of this blue line, and we'll talk again about that. It's been kind of flat to negative, and again, what we see when the bad inflation news, at least from a market perspective, is that bonds and stocks move downward together. And that's indicative of inflation driving the market. And this brown line is small cap stocks. And you can see they've been having sort of the same trends, but much, much greater volatility. And again, we'll talk about that in a little bit. But that just gives you kind of a narrative of the quarter. Really good first quarter for stocks. Not such a great month since then. So let's dig into that a little further. But before I do that, Sarah, are there any questions on the previous chart that we're not going to get into later?
Sure, and I think this would be a helpful clarification for the bond return shown in this chart. Is it the price, the yield, or what is that reflecting for the bond return?
Yeah, so that is what's called total return. That for both stocks and bonds. So that includes both any dividends that are paid out. So both stocks and bonds can pay dividends. Those are always positive. You can't have a negative dividend. And so there's dividend returns plus price movement returns. And in bonds, the dividend return is pretty much the yield on that bond. And that stays relatively constant once the bond is purchased by the fund or by an individual. And then there's price movement. So if you just buy a bond and you never ever look at it, it just continues to pay whatever interest rate it fed for the time you bought it. However, the market has what's called a price return, which is kind of like if you were to sell that bond, which you may or may not be selling that bond. Most of the time you're not selling that bond. If you were to sell that bond today, what kind of price would you get on it compared to what you bought it at? Now, you're still getting that consistent 5% return. So in some sense, if you're going to hold the bond and never sell it, this price return is kind of immaterial, but it does give us a sense of what the market is doing in terms of bonds. And certainly if you're looking at a statement and you're looking at how a fund is performing, that price return is going to be reflected in that. And what that price return means is that if you were to buy a new bond on the street, that bond would probably be paying a higher interest rate than the bond you currently hold. That doesn't mean that the bond you're currently holding is losing money in the sense that it's still paying its 5% interest rate going along. It just means that a new bond will pay a higher interest rate. So when interest rates go up, bond prices will fall. Again, that doesn't mean you're losing money in the sense that it's not paying a dividend. It just means that the price you can get on the street for that bond is less, because if I'm an investor and I have a choice of buying a 6% bond or a 5% bond, clearly I'm going to buy the 6% paying bond unless I can get the 5% paying bond at a discount. And the amount of that discount makes those two bonds equal in the forward-looking returns.
Awesome. Thank you for that explanation.
Yeah. Okay, so one thing I think it's helpful to take in context of a market as we look, and again, we're going to get into why is this happening, is you see this kind of up. Oh, great, I'm feeling really good. I've had a great quarter. And then markets goes down. And then like people like, oh, I'm really worried. But actually, market big ups and big downs are just a normal fact of life. So as we're looking at this quarter or looking at returns, what we see throughout the year is that markets go up and down a lot. So as you see here, we have these blue lines. That's the biggest intra-year gain of a market in any year. And these gray bars are the intra-year decline. So if the market went up and then it went down and then went up again, the biggest intra-year decline is that deal. You can see that in a lot of years, there's pretty big intra-year declines, but the market still ends the year up. So these teal dots, those are where the market ends the year. So in a lot of years, when the market ends up, you can see there are quite large declines inter-year. So when we see this decline over the last month, which has been pretty significant, it's about 6-ish% top to bottom, roughly. That is a pretty normal intra-year decline, right? That's right about here. So most years, we see that kind of decline almost every year. It's rare that we don't see intra-year declines in the markets. So while it's really easy to get excited about the up after a quarter, it's not unusual to see movement back, pullbacks, and then rallies all throughout the year. So we don't want to get too focused on this. Towards the end, I'm going to talk about it's an election year. Whether, regardless of what party you like or support, election years have their own market dynamics, which we'll talk about. So while we've been seeing this pullback recently, it's within the normal expectations of the stock market year, and also doesn't really tell us anything about whether it's going to be a good year or a bad year going forward. So what's been happening to cause this both sort of exuberant up and then kind of pull back over the last month? The key thing here, and we talked about this in the last quarterly update, is that we've came from the great financial crisis here out of 2008, and we had a decade plus of what was considered a very low rate environment, where inflation was roughly in the 2% range. And there were a lot of market predictions that 2% was, quote, the new normal. Well, boom, the pandemic hit, inflation spiked. If you follow markets, if you follow politics, all of this has been discussed. Good news, inflation has been coming down. And that has been really good. That has propelled markets forward. Now the question is, where is inflation going to settle out, sort of for the longer term? This dotted line, that marks just a little bit above 3%. That's kind of the historic level of inflation, depending on what exact time period you use. If you use the longest time period, somewhere in the neighborhood of 3% has been the historical average inflation. It looks right now, again, there's a lot of uncertainty here, that perhaps interest rates are going to, and inflation is going to settle out in the 3-ish% range versus this 2% range. And that is a big question. Markets are future looking, and where that inflation is going to settle out has been a big driver in how markets are behaving. We'll see where this is in 2 years down the road. It's a question about where this is going to be. So this is a chart that I showed back several quarters ago. This is from January of 2023. So just over a year and a quarter ago. And the market is always predicting where inflation is going to go, and the prices in markets are reflective of inflation. So these blue line, that's where the Federal Reserve said interest rates are going to be. Again, this is what was being predicted a year and a half ish ago. And they predicted that it was going to go, rates were going to go up to 5.1% and then come straight down. The market, I think this is really key, the market was always more optimistic and thought that rates were going to never get as high as the Fed did, and that they were going to fall more quickly. So if the market thinks differently than the Fed, that's what's priced in. And by that I mean, that means the market is going to be steady if this green line happens. That's not what happened. So now we can fast forward. This is the same chart, only we're fast forwarding to March of 2024. And we see that instead of interest rates topping out at 5.1%, which was the prediction, interest rates, oops, wrong way, sorry, actually ended up topping out right now at 5.4%. Maybe they're going to go up from here, but I think there's quite a bit of consensus, at least, that probably this is the top. But what's key is they're not following nearly as fast or nearly as far as people have predicted, or at least that's the current prediction. Those predictions have moved way up. The level set of inflation has moved way up, and that is what's causing markets the bond market to go down, the stock market to have volatility. If you recall back here the market was under-predicting, basically under-predicting where the Fed thought inflation was going to go. Both turned out to be quite wrong about rates. They almost always are. Predicting interest rates isn't, but it's important to understand where the predictions are at, because when things happen differently, that's when we have to tend to see market movements. So there's a really important thing right now, is that the market is expecting higher for longer interest rates. And the market is now actually expecting to be above where the Federal Reserve is saying our interest rates are going to go. So the market is expecting higher for longer. So that is what we've seen driving markets and the markets to go down this past quarter. So this is all the market speculating that interest rates are going to remain higher for longer. So do we think that's going to happen? Who knows? If this stays, we're probably looking at a pretty reasonable market going forward. There's a path where inflation doesn't fall as fast, or there's several people out there who are highly intelligent who actually think that the recession has just been delayed and that ultimately the economy is going to feel the effects of inflation, of the wars in the Middle East, in Ukraine, and that interest rates could go back to falling faster. If that happens, if interest rates start to fall, that is a situation where the market will certainly experience more volatility. It's anybody's guess. So we always think one should be positioned with a portfolio that will provide reasonable returns over the long run, regardless of what that prediction is. But it's important to know that this is where the market is and why that has happened to deal, and then position ourselves again for either case, because they could go up, they could be down. Obviously, markets were wrong from a year ago. The predictions were way off, but it was okay, right? And we know that the portfolio can handle this, but it's also important to know that where these predictions are at. So these higher for longer interest rates are certainly having an impact on different market sectors. So one of the big areas where they're affecting things is small cap stocks. So if you call back to our plot, this is kind of large cap US stocks. This has been small cap stocks. This is the Russell 2000 Value Index. It has been super volatile. And again, you see with good news, it has big spikes, and with bad news, it tends to go down. So these same stocks were the best performers at the end of 2023, when there was lots and lots of good news. They have also struggled this year. And the reason that they have been way more sensitive, or the market thinks they're way more sensitive, is because in general, the small cap stocks have more floating rate debt. So that means they are borrowing more money than large cap stocks. That's always typical of small growing companies. Growing companies want to invest back in the business. They don't generating necessarily as much cash flow. So they're borrowing to grow. Floating rate debt means that the interest rate that they are paying on their debt is highly tied to the interest rate that the Fed sets. So if interest rates go up, their debt costs more. That means lower profitability. If the interest rates go down, then that means their debt is a lot cheaper and makes them. So they are much more sensitive to the movements in interest rates than large cap stocks, which is again what we see. When there's good news, they've been tending to outperform large cap stocks. When there's, quote, bad news, or we think interest rates are going to stay higher for longer, that has hurt small cap stocks more. So based on that, I would expect that this volatility in small cap stocks might continue. However, it's also true that the reason we continue to have exposure to them is, on average, we think they're going to grow more, and that when there's these interest rate movements that are unpredictable, we want to have some exposure to these small cap stocks because they can go on very quick runs very quickly, like we saw at the end of 2023 when there was a huge return and boost in these sorts of stocks. But it is true that over the short term, because the market thinks that their future is so tied to this floating rate debt, that I would expect there to be more volatility. Also, as you'll see, that the 2000 Value Index is I don't know if it's overweight, but it has a higher exposure to financial services companies and a lower exposure to technology companies. So the financial services being this larger blue, dark blue slice of the pie, and technology being this sort of grayer slice of the pie here. If I were to flip this for large cap stocks, obviously a lot in the technology sector, and that has been the darling of the market. And financial services are also susceptible to interest rate movements more than other sectors of the industry. So both of those are what's driving the volatility in small cap stocks right now. Now, the funds that we choose to invest in actually have performed quite a bit better than the index, and that is because we use a profitability screen for those companies. So that is a way to look at their ability to service their debt, their ability to generate cash flow operating profits to their business. And we feel that especially in small cap stocks, that profitability screen has been very valuable in a time in which debt servicing is a big driver. And if you were to look at the funds that we recommend in this space, they have been substantially outperforming the index for that particular reason right now. And so it's just, we feel it's a really important screen, and why we don't simply invest in index funds in the small value space, or frankly anywhere, but it's particularly important in these kind of environments in the small cap space, and has added value. I think I'll pause there, Sierra, and ask if there are any questions before we jump into AI and the big tech stocks.
Yeah, absolutely. And I appreciate all the insights that you've shared thus far, Kristi. No questions at this time, but I very much appreciate you kind of outlining the impact that the uncertain rate environment has had, as well as how, especially in the US small cap space where we invest, just that makeup of the types of companies is very different from that large cap space. So it sounds like those two factors have really compounded to lead to that big difference in performance between the S&P 500 and small cap value stock.
So that brings us to our favorite topic of the past few years, which is the Magnificent Seven, and or if you want to say U.S. large growth stocks, but particularly the Magnificent Seven. Again, they have been the driver of the U.S. stock market returns. They have been a substantial contributor. If you look at the rest of the market, it's been pretty flat to negative, but the Magnificent Seven have really supported the dramatic rise in the US stock market. So the question always becomes, we have clients and folks we talk to are like, well, if they're so good, why aren't we investing more? And on the other hand, are these companies way overvalued? And why should we have any experts? Maybe they're going to crash. And so I wanted to kind of paint a picture of where our portfolio is relative to these stocks, and also what's been happening with them. So first of all, the momentum has been behind U.S. large growth stocks for quite some time. As most of you hopefully know, we have a slice of our stock allocation, which is allocated based on recent momentum. So between US and international, between large and small stocks. And right now, we have a slight tilt towards larger stocks compared to our overall tilt. So our overall tilt, we believe, is to small and value compared to the overall market. We believe in being globally diversified, and we believe in holding those at all times. But we do think that there is momentum in markets, and that has been academically shown. There's a lot of research on that things that have done well continue to do well until there's a major storm, right? We had a big storm last March when the Silicon Valley Bank failed, and that happened. But in general, markets tend to do. So right now we do have some exposure, not nearly as much as the indexes as a whole, but we do have exposure to the Microsofts, to the Apples, to the Amazons, looking through our lens again of profitability, price. We're always taking those into account. But these stocks have tended to do well, and in general, things that have tended to do well do tend to continue that momentum forward. So we're always looking at where that momentum is, and we have a slight, for us, our portfolio is a slight overweight to these. Not compared to the index, we're not nearly as concentrated, but we do have this. Why is that happening? Well, there's been a lot of question about, are these companies in a bubble? Has the market expected too much of them? Is the future too bright? Or is this AI? And I think one thing that's really, really important to look at when you're thinking about the valuation of companies and are things are in a bubble is earnings growth, right? Like, so bubbles tend to happen when the price of a stock compared to its earnings, this is the price to earnings ratio, gets way out of line because there's just wild predictions of future earnings growth, and investors are willing to pay any price. They're not price sensitive. So while the price of these Magnificent Seven companies, on average, some of them not so much, Tesla particularly, Apple struggled recently, but a lot of them have been seeing earnings growth. So you'll see this is the year-over-year earnings growth of the Magnificent Seven. This is Q1 of 2023. Q2 of 2023, Q3, Q4. And you can see that while their price has risen, their year-over-year earnings growth has also been incredibly high. So we are not at a point that has been seen in markets in the past with regards to the price to earnings. The earnings growth has, relatively speaking, supported the price growth so far. Now, these are predictions. Q1 2024 earnings are just coming out. So this is as of April 1st, but are just coming out. We'll see where they are. That will make a big, markets are watching this closely. But right now, analysts are expecting that year-over-year earnings growth of the Magnificent Seven to taper. And I think what's most important is this is the earnings growth of every other stock outside in the world. And you can see that there has been minimal earnings growth here. There is a strong prediction that by Q4 of 2024, so pretty soon, the earnings growth of the other stocks in the world is going to start to exceed the year-over-year earnings growth of the Magnificent Seven. These are predictions. Predictions are known for being poor, and we are not investing based on predictions. Again, we based on past trends, on price, on book value, on size. We use real-time market data. We're not using predictions. But I think it's really important to understand that if this crossover proves to be true, the prospects for the rest of the market, we call it market breadth, how many stocks are doing well versus how much is concentrated in a few stocks. There might be a real tide turning, right? This is an important measure to watch in terms of what's happening with the rest of the world's stocks. The other thing to note about the international stocks, small value stocks, besides earnings growth, is the strength of the dollar. So I didn't put a chart in here, but actually, if you look at international stocks right now, they've been doing quite well on a return basis, but the dollar has strengthened a lot. And the reason for that is our continuing higher interest rates, inflation in the US compared to the rest of the world. And so while international companies can be doing very well on their own, their stocks in US dollars are influenced by what's happening with the US dollar, and the US dollar has been strengthening. So that's where this idea of what's happening with interest rates and inflation in the US actually can play into whether US stocks or international stocks do well from a total return standpoint. Again, back to our previous conversation, it's the earnings growth of the company plus what's happening to the dollar for international stocks. So that's another area where there's a lot of question about whether the tides are going to turn over this next kind of year and a half, because international companies on a whole have been doing quite well, but their stocks have lagged because, again, this is international versus US. A lot of this difference in return has been driven by the movement of the currencies. And that is, you talk about earnings predictions. Earnings predictions are, marginally good. Currency predictions, oh my goodness, that's like a whole nother level of what's going to happen in the world, what's going to happen with wars, what's going to happen with China, what's going to happen with the perception. So we continue to have exposure to international stocks. That's an area we're watching, again, just looking at the market momentum. But for right now, US large stocks have continued to do well, and we have benefited by having, for us, a relative tilt away from small in value to those larger growth stocks. Being always mindful of not making sure we're buying, having price indiscriminate buying, as I like to say. We want to always be mindful of the price that we are paying and the price of that relative to the book value relative to the profitability of the company. So with that, Sarah, any questions on where we stand relative to exposure to large tech stocks and where we are in that market?
No, I think you've just about covered it. Thank you.
Great. So with that, we talked a lot about kind of the stock market and US stocks and international stocks, but we hadn't for a few quarters talked about kind of our specialized assets. So these would be real estate, alternative lending, and some of the things that we include in the portfolio, specifically because they tend to perform differently than stocks and bonds, right? So most of the world, our clients, our portfolios have an allocation to stocks because on average, stocks power growth and they do so in a very tax efficient way, right? They're a very tax efficient way to get growth in a portfolio. We include bonds because in many cases, bonds move differently than stocks, right? So when stocks are going down, bonds on average, more times than not, go up because interest rates are falling. We've seen in recent years and this year to a degree that in certain environments, certain economic environments, stocks and bonds can go down together. So the most recent reminder of that was 2022, right? This is an ugly year, a difficult year because stocks and bonds went down together. So why do we include specialized assets and how have they done? So Lendex is our alternative lending fund. It invests in ours. We invest in this fund on behalf of our clients. It's something we've due diligence in-house. It is not a fund Merriman runs. We partner with a third-party manager to run that fund. But you can see that in 2022, it offered a positive return compared when all the other asset classes were down that we have in our portfolio. That is super valuable, and it's exactly why we have funds like that. Is we're always looking for asset classes that are going to perform and deliver a positive return in years when many other asset classes have negative returns. Forward to last year, and you can see that Lendex was actually down when all the other asset classes that we have in our portfolio provided positive returns. I got some questions about, well, why would I have Lendex? Like it was kind of like didn't do so great last year, right? Like not a really great year for it. Actually, that's I would argue that's exactly what we want, right? It had a great year in 2022. It provided a nice boost and a way to generate income and a way to sell some, to rebalance. And then when everything else is up and up, it's going to have a negative year sometime. No asset classes are immune from ups and downs of investing. And so to have this, but have it happen in a year where other asset classes in the portfolio had outstanding years is exactly what we expect and what we want specialized asset classes to do. Here's a year where real estate and bonds are down, stocks are up. That's a great year, right? You're getting some return from here. It might be a different year where different asset classes are up. So we're never expecting any asset class in the portfolio to have good years every year. What we're trying to find is asset classes which perform differently than each other. So we love years in which some are up, some are down, because that means we have insurance in the portfolio and a portfolio designed to deliver a mix of returns regardless of what economic conditions we see going forward. So yes, it is true that Lendex didn't have a solid year. Last year it was down. You never want anything to be down, but also it is much better to have a down year in a year where the other parts of the portfolio were up. And that's the kind of behavior we expect from that. Is in a year where after it's been up, there might be some credit challenges and that come to light sort of after sort of the stock market has fallen and you have a bear market year. That's exactly the behavior we expect from that asset class. Also wanted to talk a little bit about real estate. If you follow headlines, there's been a lot of discussion about offices and really negative returns of real estate. And I want to offer two things. The first is that real estate is highly diversified. So the global real estate fund that we use actually has only a very small slice of exposure to office real estate. So if you're seeing all the headlines about buildings in every large US city are not occupied, rents are going down, the death of offices, all the kind of scary headlines, real estate to us does not mean office real estate. Doesn't mean we don't have any office real estate. We do have exposures in our portfolio, but we have exposure to all kinds of different real estate, which are not there. And this is actually a relatively small slice and includes office parks in kind of suburban areas or non-downtown areas. So when you think about when you go to the dentist or your medical clinic, right, those office parks, that also is included in this category of office. And you might see there's healthcare, there's data centers. So talk about real estate and AI, right? Lots of discussions about how data centers are actually benefiting, and the more we're using AI, the more demand for data centers and energy there's going to be, multifamily residential, telecom towers, retail, industrial. So when we talk about real estate, it's really important to understand that real estate means a lot of different things, not just that downtown office tower that you may be worried about a lot. And you can see from here with these yellow bars that real estate has had both good years and bad years recently, right? 2020 with COVID was a real challenging year for real estate. Next year, it rebounded. It was the best asset class in the portfolio here. 2022, another difficult year, but again, along with that, decent year last year, positive returns, but we will see what happens. I think there's also been a lot in the news about what does interest rates do to real estate. Obviously, that's a really interesting question, and there are a lot of different outcomes possible for that. But it's important to know that historically, during Fed tightening cycles, real estate has not been, by definition, a poor asset class. And also that public and private real estate can have very different behaviors during this. So the gray bars are private real estate, and the bright blue bars are public real estate. So what you tend to see is kind of what we call a stale pricing in private real estate. These private real estates and public real estate are often investing in the same asset class. So say they're investing in the same office building. The public market is going to anticipate that rents are going to go down, that debt payment servicing is going to go up, and it's going to fall much more quickly than the valuations being reflected in private real estate. So private real estate tends to have what we call a stale pricing effect, and public markets are reflecting the future sooner, and private real estate are reflecting valuations, appraisals, and that can take 6 months or a year to reflect. And so what you see is that private real estate tends to have worse returns kind of later in the cycle, and public real estate tends to have better returns. So if you're seeing headlines in the news about big private real estate having issues, or your friend's private real estate or apartment building is suddenly having trouble, because we know a number of clients who have exposure to private real estate, I expect that bad news may continue for a little while here, because it tends to lag the public markets, which tend to go down much more quickly. They're very liquid. They're priced by everyone figuring out what things are worth versus, again, this scale pricing. So if you're seeing or hearing about private real estate deals that are going south, that doesn't necessarily mean that your REIT is going to continue to have trouble, because again, it's a lot of that pricing pressure has already been reflected. It was reflected in 2022, in 2020. We don't know, but generally speaking, bad news is reflected in private real estate much later than it is in public real estate, and that's what we see. And tightening cycles do not necessarily mean bad returns for real estate. No one knows. But I think it's important to understand that we can have bad years and then followed by really good years in the real estate market, and that we have very diversified exposure. So bad news in the office market does not necessarily translate to bad news in the overall real estate sector. Great. So we talked a lot about, or I always say, all this is what's happened. This is what the market thinks is going to happen in the future. That's what's priced in. But also, the future is highly uncertain. And so we want to continue to remain diversified in our exposure. The biggest thing that we're getting questions on about what's going to happen this year is that there is a general election in November. And general elections these days generate very strong feelings and generally cause angst and nervousness in the investment markets. And I'll talk about that in a little bit. But I think it's important then to go back and look at the data. This is data from 1926 through 2023. And it's really important to understand that there is no correlation between presidential election years and poor years in the stock market. There can be poor years in the stock market in election years. There can be really good years in the markets in elections. Elections, by definition, historically do not help or hurt stock returns. They're kind of within the average of all the years. So again, this is the average return of the US stock market on all the years. This is in presidential election years. It's higher. I don't think that's statistically significant. I would consider this very much just in the general realm of there. But just because that there is an election coming up in November, even if it's contested, even if it's not your party who prevails, it's generally been true that US stocks continue to do well. What's interesting is that despite the data that says that stock markets do fine in years of elections, investors tend to pull their money out of the market. So if you look at flows into money market funds, so that's cash, pulling it out of the market and putting it in cash, some cash vehicle, in presidential election years versus non-presidential election years, people, investors, money flowing into funds is much higher into money market funds in presidential election years than it is in non-presidential election years. It's lower into stocks and bonds and higher into cash. So this is the last presidential election. So this is 2020 election. You can see how much money was pulled out of the market and put into money market funds compared to put into stock and bond funds. So despite the fact that there is no data that suggests that the stock market is going to be hurt by an election year, there is going to be volatility. And if history is any judge, people are going to want to pull their money out of the stock market and put it in cash. And that's going to hurt them. So if you are considering that, or you have friends or family who are considering that, One of our big beliefs is that we want to be data informed and data driven. We want to make decisions based on data, based on statistics, not based on our emotional response to things. And this can be a very emotionally charged item. And so we want to be clear that we think it's very much to investors' advantages, to our clients' advantage, to stay invested through the market, regardless of what happens in the election, whatever outcome it is, and also to expect that in the second and third quarters leading up to the election, that this will become a topic of a lot of headlines and a lot of volatility possibly driven in the market, but that on average, the stock market goes up in election years, and it is important to remain invested, to remain in a diversified portfolio, and to continue to follow our investment strategy. So that's what we will be doing on behalf of clients. We will not be shifting to cash or changing our allocations because it is an election year. I think with that, we have about 5 more minutes before we're scheduled to end. Chair, are there any other questions or topics which you'd like me to cover before we wrap up here?
Absolutely, yeah. Thank you, Kristi, and this has been super helpful. I do have maybe 1 or 2 questions here that we could chat through. One is jumping back a little bit to your comments about the value of the dollar and how that impacts how US stocks perform, especially compared to international stocks. And the question is, are there red flags or concerns on the horizon about a decline in the value of the dollar?
Yeah, so a decline in the value of the dollar. So international macroeconomics are super super complicated, and so certainly if the dollar declines, like that will boost international stocks, right? That will sort of shift the balance of trade and the fortunes of those companies. So it will be certainly a windfall for international stocks, for US investors who are invested in those in US dollar funds. So if the dollar falls again, which eventually it will, who knows when that will be, certainly international stocks will have a windfall from that, and it will be a headwind for US stocks. Now, the thing is, for a lot of US stocks, especially large company stocks, their customer base is always already so global, right? Most of these large US companies already market globally. And so whether that negatively affects them nearly as much is unclear. I mean, it is definitely true that in the last couple decades, the correlation between US stocks and international stocks, if you take the currency aside, has become more correlated as more and more, companies based in Germany and Japan have started to sell products in the US, and US companies have started to sell products abroad. They're just more driven, all of them, by the kind of fate of the global economy. Now, whether that pullback happens over the next, let's go like 20-year time horizons, 10, 20-year time horizons, which are very different, right? There is a trend towards deglobalization. Companies are pulling and countries are pulling back from sort of these multi-nation trade agreements, more protectionist tendencies, more global tensions. And so I think if you're thinking about the next 10 years, forget the next 6 months or a year, you're going to see impacts of that. And in some sense, that drives it to be more important to be diversified into US and international, because when one goes in and out of favor and they go in and out of favor differently, that is better for portfolios to kind of smooth the ride. So certainly if the dollar falls again, that will be a boost for international stocks. International stocks have been on sale for a very long time. That can't continue indefinitely. I think if you're looking the next 10, 20 years, the likelihood that international stocks will outperform US stocks just based on historical valuations, mean reversion, which tends to happen over 10-year kind of time frames, they look really, really attractive compared to US stocks. We're finally seeing Japan kind of break out of a decades-long slump. But whether that happens, 2 years from now or 6 years from now can happen quickly. I don't know, but it will definitely, international stocks are on sale historically and US stocks are not. And that has always come to play in the decade kind of timeframes.
That's helpful. Thank you. And you were actually able to answer another question as well that came in about is the US stock market right now expensive compared to the international stock market? And as you said, it sounds like international stocks are on sale right now and US stocks are a bit more expensive.
Definitely. That is absolutely true. International stocks are historically on sale right now. The problem is that just because they're on sale doesn't mean they can't be more deeply discounted, right? That's the valuations are contain some information about what will happen over the next 10 years. They contain almost zero information about what will happen over the next year. So they're good long-term predictors. On the very, very short term, momentum is very much a better predictor. And when I say this, this is not my view. This is like years of study of markets by academics, that in the short term, momentum is a better predictor. Over the long run, valuations are a better predictor. All of them are, anytime in markets, if you can be right 60 or 70% of the time compared to a 50-50 coin flip, that's pretty good. So nothing's ever 100%. We're just talking about increasing the odds from a 50-50 coin flip to being 60 or 70% of the time, which is really much better than a 50-50 coin flip, but also never a grand certainty, which is again why we believe it's so important to have some exposure to all kinds of different asset classes on a continual basis, regardless of what's happening at the moment.
Mm-hmm. Absolutely. And I think that's such a great point for us to wrap up on is there are so many things when it comes to investing that are uncertain. So if we focus on the things that we can control, like being diversified, staying in our seat, especially being in an election year, knowing there's going to be volatility in the markets around that, by staying focused on the long term, we can control those outcomes a bit and have a better investment experience.
Thank you for that wrap up, Sarah. Thanks to everyone for joining. We will be sending out a link to the recording in case you weren't able to make the beginning. And if not, if you have any questions, please feel free to reach out. We're always here to help. Thank you.